Why is owning assets more important than income? Two people, same age, same neighborhood. One earns $120,000 a year and still wonders where the money went at the end of every month. The other earns $60,000 and is quietly building wealth while he sleeps. Same economy, same opportunities, completely different game. Here's what nobody tells you. Getting better at earning and actually building wealth are two completely different skills. And most people spend their entire working lives mastering only one of them. According to the Federal Reserve's 2025 Wealth Report, the top 10% of Americans hold nearly 67% of total national wealth. And the vast majority of that didn't come from salaries. It came from things they owned. A teacher I read about never earned more than $58,000 a year her entire career. She retired at 61 without financial stress. Not because she got lucky, because in her 30s she quietly started buying assets instead of just earning income. Today, we're going to talk about 4 shifts that explain why ownership always outpaces income over time. And the 4th one is where most people realize they've been playing the wrong game entirely. Comment, own it, if you're ready to change that. Let's start with something most people have never actually stopped to calculate. Think about the best raise you ever got. Maybe it was 5%, maybe 10% if you were lucky. You felt it for a month or two, and then life quietly expanded to fill the new number. The groceries cost a little more, the car got a little nicer, and by the following year, you were more or less back to the same feeling you had before the raise. Working just as hard, wondering where it all goes. That's not a personal failure. That's the math of linear growth working exactly as designed. When you earn a salary, your income moves in a straight line. You put in the hours, you get paid for the hours, you get better at your job, and you negotiate a higher rate for the hours. But it's always hours in, dollars out. The ceiling on that equation is real. Even if nobody says it out loud, there are only so many hours in a week. There are only so many years in a career. And at some point, no matter how talented or dedicated you are, the line stops climbing. Now compare that to what happens when you own something. A share of a well-run company doesn't clock out at 5. It doesn't take sick days. It doesn't negotiate for a raise or burn out after a difficult quarter. It just keeps participating in the growth of whatever it's connected to. And that growth doesn't move in a straight line. It moves based on revenue expansion, on improving margins, on the market's expectations of what that business will be worth 5 and 10 years from now. The math is structurally different. Not a little different. Fundamentally different. Here's a way to feel that difference concretely. Imagine 2 people in 1995. One invests $10,000 into an S&P 500 index fund and leaves it alone. The other puts that same $10,000 in a savings account, earning modest interest. 30 years later, according to historical return data tracked through early 2026, the index fund position has grown to somewhere in the range of $200,000, depending on the exact timing. The savings account has maybe doubled. Same starting point, completely different destinations. The difference wasn't effort, it was structured. There's a story from ancient Babylon that captures this better than any spreadsheet. A young merchant worked alongside 2 older traders in the same marketplace. All 3 started with nothing. After 10 years, the first merchant had saved a modest sum from his daily trading. The second had done the same, but the third had taken his early savings and bought a small share in a caravan that traveled the Silk routes twice a year. He didn't travel with it. He didn't manage it. He simply owned a piece of it. After another 10 years, the first 2 merchants were still trading daily, still dependent on showing up, still exchanging effort for coin. The third one had quietly accumulated enough from his share of the caravan profits that his daily presence in the market became optional. Not because he worked harder, because he understood that ownership and labor are 2 different engines, and only one of them runs while you sleep. The practical question worth sitting with here is this: What is the actual ceiling on your income in your current situation? Not the theoretical ceiling, the realistic one. What's the most you could realistically earn in the next 10 years? Working harder, getting promoted, doing everything right. Write that number down somewhere. And then ask yourself whether that number by itself gets you where you actually want to be. For most people, the honest answer is that it gets them close, but not quite there. Not because the number is too small, but because income alone, without ownership behind it, tends to maintain a lifestyle rather than build a foundation. That's the ceiling. And the only way through it isn't to work harder within the same structure. It's time to start adding a different structure alongside it. But here's where it gets more uncomfortable. Because the ceiling on your income is one thing. What happens to all that effort when you're not in the room is something else entirely. Here's a question I want you to sit with for just a moment. Think about the last full week you worked. The meetings you showed up to, the problems you solved, the energy you put in. Now ask yourself honestly, who benefited most from that week? Not who paid you for it. Who actually benefited most? Because there's a version of that answer that most people never fully reckon with. When you sell your time and skill to an organization, you receive a wage. Fair enough. But the organization receives something different. It receives the output of your effort, packaged into a product or service, multiplied across thousands of customers, compounded over years, and ultimately reflected in the value of the business itself. The business grows. The owners of that business accumulate wealth, and you receive your portion, which was agreed upon in advance and doesn't change much regardless of how well the business does. That's not a complaint about how the system works. It's just an accurate description of it. A 2025 analysis by the RAND Corporation found that between 1975 and 2024, American worker productivity increased by roughly 65%. Median wages over the same period, adjusted for inflation, increased by about 15%. The gap between what workers produced and what they were paid didn't disappear. It flowed somewhere. And somewhere, overwhelmingly, it was into the accumulated value of the businesses and assets owned by people at the top of the wealth distribution. Again, this isn't about blame. It's about understanding the structure clearly enough to make better decisions within it. There's a teaching that gets passed down in Jewish tradition about the difference between the laborer and the landowner that I find quietly clarifying. The story goes like this. Two men work the same harvest season. The laborer arrives before dawn, works through the heat of the day, and earns his wage when the sun goes down. It's honest work. It's dignified work. And at the end of the season, he has enough to carry him through the winter. The landowner also works hard. He negotiates, he manages, he worries about weather, markets, and yields. But at the end of the season, what he holds is not just this year's harvest. He holds the land itself, which will be produced again next year. And the year after that, and the year after that. The laborer exchanged effort for sustenance. The landowner exchanged effort for something that kept producing after the effort stopped. The principle isn't that labor is beneath anyone. The principle is that labor alone, without ownership attached to it, resets every season. Now translate that into modern life. If you've been working for 20 or 30 years, you've produced an enormous amount of value. Real value. The question is how much of it you own versus how much of it you handed over in exchange for a paycheck. And the answer for most people, if they look at it honestly, is that they own very little of what their effort helped create. The shift starts when you begin treating your income not as the destination, but as raw material for acquiring ownership. Even small amounts, even imperfect amounts. A person who earns $65,000 a year and consistently directs $400 a month into an index fund that tracks the broad market is buying a tiny piece of hundreds of companies each month, each year, each decade. And over time, those companies keep producing, keep growing, keep reflecting their value upward, whether that person shows up to work that day or not. There's a woman I came across in a retirement forum who worked as a hospital administrator for 34 years. Never a flashy career, never a dramatic salary, but from the age of 38, she put a fixed amount every month into a simple ownership position in the market and never touched it. She didn't time it, she didn't manage it, she just owned a piece of something larger than herself and let it run. By the time she retired at 67, that position had grown to a number that genuinely surprised her. Not because she was brilliant, because she was consistent. And because she understood, earlier than most, that her paycheck was never the point. It was always just the starting material. The uncomfortable flip side of this is worth naming too, because it's not just about what you're missing by not owning. It's about what happens to the people around you when they don't own either. Most people have heard of compound interest. They learned about it in school, maybe, or saw it mentioned in a personal finance article at some point. They nodded, thought that makes sense, and moved on. And that's exactly the problem, because compound growth is one of those things that sounds straightforward in theory and feels almost invisible in practice, at least for the first several years. And because it feels invisible, most people underestimate it so badly that they never actually let it work. Here's what it really means in plain terms. When you own an asset that grows, the growth itself becomes part of the asset. And then that larger asset grows again, and the growth from that growth becomes part of the asset, and so on. It's not complicated, but the effect over time is so disproportionate to what most people intuitively expect that it almost feels like a trick the first time you really let the numbers land. Let me give you something concrete to hold on to. A person who puts $500 a month into a broad market index fund, starting at age 45, and earns an average annual return of 8%, which is conservative by historical standards, will have somewhere around $180,000 after 20 years. That's $120,000 of their own money, plus roughly $60,000 that the growth generated on its own. Now take that same person, same habit, same return, but they start at 35 instead of 45. Same $500 a month, same 8%. After 30 years, instead of 20, the total isn't $270,000. It's closer to $680,000. The extra 10 years didn't add a third more. It nearly quadrupled the outcome. That's not a rounding error. That's the structure of exponential growth doing exactly what it's designed to do. Benjamin Franklin understood this better than almost anyone in American history, and he demonstrated it in the most unusual way. When he died in 1790, he left a modest gift of about $4,400 each to the cities of Boston and Philadelphia. But there was a condition attached. The money could not be touched for 100 years. After 100 years, a portion could be used for public works, but the remainder had to sit for another 100 years. By 1990, 200 years after Franklin's death, that original gift had grown to nearly $6.5 million across both cities. He didn't leave them a fortune, he left them time. And time, attached to ownership, did the rest. The reason most people never feel this working in their own lives isn't that they don't believe the math. It's that the early years feel discouraging. You put in $500 a month for a year, and the account shows $6,200. Maybe a little more if the market cooperated. It doesn't feel like anything is happening. It feels like you're just moving money from one pocket to another with a small tip added. And so people lose patience. They pull the money out for something more immediate. They tell themselves they'll start again later when they have more to invest. And later becomes the most expensive word in personal finance. There's a quiet story worth sharing here. A retired mail carrier named Gerald, 71 years old, from a small town in Indiana, was interviewed for a local newspaper feature about ordinary people who had built surprising financial stability on modest incomes. Gerald had never earned more than $52,000 in any single year of his career. He drove a used car. He lived in the same house for 38 years. But from the age of 33, he automatically directed a fixed percentage of every paycheck into a retirement account invested in the broad market. He didn't watch it obsessively. He didn't move it around, chasing better returns. He just owned a piece of American business, consistently for decades. By the time the reporter spoke with him, his account balance was just over $900,000. Gerald laughed when the reporter seemed surprised. He said something that stuck with me. He said, "I didn't grow that money. Time grew it. I just didn't interrupt it." That last sentence deserves a moment, because the single most common way people undermine compound growth isn't bad investment choices. It's an interruption, pulling money out too early, pausing contributions during difficult months and never restarting, letting the account sit idle during the years when it matters most. Compound growth doesn't punish bad decisions loudly. It just quietly removes the years you could have had, and you only see the difference at the end. The practical thing here is less about strategy and more about structure. The people who benefit most from compound growth are almost never the ones who manage it the most actively. They're the ones who set it up correctly once and then get out of the way. Automatic contributions, broad diversification, long time horizon, low interference. That's the whole system. Not glamorous, not complicated, just consistent ownership over time. And once you understand why consistency beats intensity in the ownership game, something else starts to become clear. Something about how income and ownership actually relate to each other, and what most people get backwards, about which one is supposed to serve which. There's a mental model that most high earners carry without realizing it. And it goes something like this. First, I'll earn enough, then I'll save what's left. Then someday, when the timing is right, I'll start building something real. It sounds reasonable, it feels responsible, and for the vast majority of people who follow it, it leads nowhere particularly interesting. Because the timing never feels quite right, and what's left after spending is rarely enough to build anything meaningful. And someday has a way of becoming a decade, and then two. The people who actually cross from earning to owning don't wait for the timing to feel right. They change the order of operations. Here's what that looks like in practice. Instead of earn, spend, save whatever's left, the sequence becomes earn, allocate to ownership first, then live on what remains. It sounds like a small adjustment. It's actually a complete reorientation of how money moves through your life. Because when ownership comes first, before the discretionary spending, before the upgrades, before the lifestyle creep that follows every raise, the asset base grows steadily, whether the month felt abundant or not. A 2025 study from the National Bureau of Economic Research tracked two groups of middle-income Americans over a 15-year period. The first group consistently prioritized lifestyle spending and saved what remained. The second group consistently allocated a fixed percentage to ownership positions before adjusting their spending. Both groups had similar starting incomes. Both groups experienced the same economic conditions. After 15 years, the net worth gap between the two groups was not modest. The ownership first group had accumulated on average 3.4 times more wealth than the spend first group. Same income, same economy, different sequencing. Marcus Aurelius wrote something in his private journal, not for publication, just for himself, that has stayed with me since I first read it. He observed that most men confuse the instrument with the goal. They spend their energy perfecting the tool and forget to ask what the tool was meant to build. He was writing about virtue and philosophy, but the observation maps perfectly onto how most people relate to their income. The salary is the instrument. The ownership it can purchase is the goal. When you treat the instrument as the destination, you end up with a very well-maintained tool and nothing built. The shift from seeing income as the point to seeing income as the raw material changes everything about how you make daily decisions. That $80 dinner out is no longer just $80. It's $80 that isn't moving toward ownership this month. That's not a reason to never eat out. It's just a clearer way of seeing what each choice actually costs in terms of the direction you're trying to move. Most people never develop that clarity because nobody framed it for them that way. They were taught to earn more, not to allocate better. Now here's the part that tends to land differently depending on where you are in life. And I want to be straightforward about it rather than dress it up. If you're in your late 40s or 50s, you may be sitting with a quiet version of the question, is it too late to make this shift matter? And the honest answer, the one that holds up when you look at actual data rather than motivational generalities, is that it depends entirely on what you do with the next 10 years rather than what you did with the last 30. A 2026 Vanguard retirement analysis found that Americans who began serious ownership-focused investing between the ages of 50 and 55 and maintained it consistently for 15 years still accumulated median portfolio balances that meaningfully exceeded what they would have had relying on Social Security and savings alone. The compounding window was shorter. The outcome was smaller than it would have been if it had started earlier, but it was real, substantial, life-changing in practical terms. There's a man I read about named Robert, a 53-year-old project manager from Arizona who spent his 40s earning well and spending accordingly. Nice house, 2 car payments, the full American expense structure. At 52, after a health scare that made him reassess everything, he restructured his finances completely, sold 1 car, refinanced the house, and redirected $1,500 a month into a simple, diversified ownership position. He told an interviewer 2 years later that he wasn't trying to get rich. He was trying to get free. And what he meant by free was specific. He meant the point where showing up to work every Monday morning was something he chose rather than something he owed. That distinction between choosing and owing is the real finish line. Not a number in an account. Not a particular lifestyle, just the morning when your alarm goes off and you realize that getting up and going in is genuinely optional, that the assets you've built are covering the baseline. The income from your work is now extra rather than essential. Some people hit that point at 55, some at 65, some never quite get there because they never made the shift from earning to owning. But the people who do get there consistently describe it the same way. Not as a dramatic moment, as a quiet morning when something that used to feel heavy simply wasn't there anymore. The question worth sitting with tonight, not with anxiety but with genuine curiosity, is this. What would it take, starting from exactly where you are right now, to begin moving your income toward ownership in a way that feels sustainable? Not a dramatic overhaul, not a sacrifice that makes daily life miserable. Just a steady, consistent reallocation that points your financial life in a direction that compounds over time rather than resets every month. You don't have to have the full answer tonight, but the people who eventually cross that line are almost always the ones who started asking that question seriously, even when the answer still felt far away. And that, honestly, is where the whole conversation has been pointing from the beginning. I want to be honest with you about something before we wrap this up. And I'm sharing this not because it makes me look good, but because I think it might sound familiar. For most of my working life, I was genuinely good at earning. I showed up early. I worked late. I got the promotions. I negotiated the raises. And every time my income went up, I felt like I was making progress, like I was doing it right. The number on my paycheck was the scoreboard. And by that measure, I was winning. What I didn't realize, for longer than I'd like to admit, was that I was playing the wrong game entirely. I remember sitting down one evening in my early 50s, doing one of those net worth calculations you see in personal finance articles. Income on one side, assets on the other. And what I found on the asset side was almost embarrassing, given how many years I'd been earning. A modest retirement account I'd contributed to inconsistently, some equity in the house, a savings account that looked reasonable until you divided it by the number of months it would actually sustain my life. That was it. Decades of effort, and the ownership column was nearly empty. The part that stayed with me wasn't the number itself. It was realizing that I'd been treating my income as the destination for so long that I never seriously asked what it was supposed to be building toward. I earned, I spent, I lived well, by most measures, and I told myself that as long as the income kept coming in, everything was fine. What I hadn't accounted for was the obvious thing sitting right in front of me. The income was only fine as long as I kept showing up to produce it. That's a fragile system, and it took me longer than it should have to see it clearly. Here's what I've come to understand since then. Not as theory, but as something I've watched play out in real time, in my own life and in the lives of people I know well. The shift from earning to owning isn't primarily a financial event. It's a psychological one. It requires you to stop seeing your paycheck as the point and start seeing it as the raw material for something that will eventually outlast your working years. And that shift is harder than it sounds because the paycheck is immediate and real, and the ownership you're building feels abstract for a very long time. There's a moment I remember clearly. I was talking to a neighbor of mine, a retired electrician named Dave, who had never earned a particularly high income by any measure. We were talking casually about retirement, and he mentioned, almost in passing, that between his rental property and his investment accounts, his monthly passive income now exceeded what he used to earn working full-time. I asked him when he started building that. He said 38. He said he just decided at 38 that every raise he got, he would put half of it directly into something he owned before he ever got used to spending it. He never missed it because he never had it in the first place. I thought about that conversation for weeks afterward, not because the strategy was complicated. It isn't. But because Dave had understood something at 38 that took me considerably longer to grasp. That is the best time to redirect income toward ownership is before lifestyle inflation makes it feel impossible. Before the bigger house and the nicer car and the accumulated commitments quietly consume every raise you ever get. The version of this I'd offer to anyone watching right now, wherever you are in the journey, is this. You don't need to overhaul everything at once. You don't need a perfect plan or a large starting amount or the right moment when everything lines up. What you need is one clear decision made today, even a small one, that points your income in the direction of ownership rather than just consumption. One automatic contribution, one position started. One habit is established that compounds quietly in the background while you continue living your life. Because here is what I know now that I wish I had understood earlier. The gap between people who end up financially free and people who end up financially dependent in their later years is rarely about intelligence or talent or even income level. It's almost always about one thing: how early and how consistently they started converting what they earned into something they owned. You still have time to make that shift meaningful. The question isn't whether it's too late. The question is whether today is the day you decide to stop waiting for a better moment that was never coming anyway. And that question, I think, is worth sitting with tonight. So here's the simplest version of everything we've talked about today. Income keeps you going. Ownership is what actually gets you somewhere. The ceiling on earnings is real. The math of compound growth is real. The quiet difference between people who end up free and people who end up dependent is almost always traced back to one decision made earlier rather than later. To stop treating income as the finish line and start treating it as the starting point. Pick one thing from today. Just one. An account to open. A contribution to automating. A number to finally calculate. Start there. Comment, own it below if something in this conversation shifted the way you're thinking. And if you want to go deeper on building real financial stability in your 50s and 60s without the complicated jargon, tell me in the comments what topic you want next. The best time to start was 20 years ago. The second best time is today.